Hi, I'm Tekoa De Silva with Sprott Global Resource Investments, and I'm sitting down here again today with Rick Rule, Chairman of Sprott U.S. Holdings. Rick, good to see you again.
Tekoa, thanks for making this happen.
It's a pleasure to have you here. What I'd like to ask you about today is a concept that we've talked a little bit about, optionality. In the resource business, I understand that it has a pretty specific definition. So for the person watching, could you talk a little bit about that word? What does it mean?
Optionality is a speculative technique that works particularly well when entered into during bear markets, coming into bull markets. What optionality refers to is buying into a company or a deposit that isn't economic at current commodities prices, but could be very economic at much higher commodity prices. The idea, as an example, would be a copper deposit that would make somebody no money at all at $1.50 a pound might be extremely economic at $3 a pound. The consequence of that is that you might be able to buy it at $1.50 a pound based on its net present value, which is almost nothing, and sell it if the copper price went up at a much, much higher price. In the last bear market that we went through, the 1998 to 2002 bear market, the predecessor to Sprott Global, which was Global Resource Investments, used this technique to very good effect. As an example, Paladin Uranium, which we've talked about before, a play on higher uranium prices, benefited by going, I'm not kidding, from a low of 1 penny to a high of $10. But it wasn't the only uranium source that soared on stock that soared on higher uranium prices. The whole sort of early stage uranium group, all hoarders, all people that were playing on optionality, all went higher. And it wasn't just uranium. Pan American Silver went from a financing price of 50 cents to a high of 40-something dollars. Silver Standard went from 72 cents to a high of 40-something dollars. But the real winner there was Lumina Copper, run by Ross Beatty, a classic hoarding strategy, which went from a low of 50 cents and, as I remember correctly, was sold off in pieces for a total realization of about $160. And by the way, Tekoa, this took place over 6 or 7 years. The idea goes like this, Tekoa. One of the fallacies in the exploration and development business is that if you think a commodity is going to go up in price, you get a deposit and you spend hundreds of millions of dollars to put it in production because you think the price is going to go up. Often, 5 or 6 years from now, when the price does go up, you have a hole in the ground where your gold used to be. The gold price is up and your gold is all gone. Why not leave it in that first hole in the ground, and when the price goes up, sell it to somebody else who wants to use the then present gold price to establish the deposit's value?
So the term optionality, we're thinking of a company or a deposit that can function like an option, like a call option on the price of a commodity?
But truly a leveraged call option. One of the things about commodities options is that they have fuses, if you will. A 2-year option gives you a play for 2 years. A 6-month option gives you a play for 6 months. A well-constructed public company that has fairly low general administrative and holding costs is almost like a perpetual option, a 10-year option or a 12-year option. And the leverage inherent in these options is unbelievable. When Bob Quartermain was constructing Silver Standard, he didn't pay more than 5 cents an ounce for silver in the ground. 6 or 7 years out, people were paying $1 or $1.20 an ounce for silver in the ground. And Bob didn't have to do anything to advance his ounces. All he had to do was own them and not mine them. And one thing I've learned in 40 years in this business, Tekoa, is that not mining is much easier than mining.
So Rick, I'm glad you mentioned general administrative costs and some of the things, the variables that a person needs to be aware of, because the question I want to ask you as we get into this is what can go wrong with an optionality play. But I guess to start with, what needs to go right? What are the basic elements that you need, the 3 or 4 things to make a great optionality investment?
I think you need to do it when the anticipation in the general market is that commodity prices aren't going to go up, when despair is present. And I have to say, Tekoa, the last 3 weeks, despair has been particularly thick. That isn't to suggest that despair hasn't been present for the last 3 years. So the first criterion has been met. The second criterion is that as a consequence of financial distress in the mining business, that companies are looking to sell assets that they consider to be redundant. That is, those assets that aren't generating cash. And certainly assets that aren't economic at this price must be considered to be redundant. And the industry does in fact need to raise cash. The third thing is that the management teams has to be, this is going to sound very strange to you, but you'll understand as we go on. The management teams have to be desperate enough that they're willing to do the right thing. You know, Tekoa, convincing a management team that's been brought up to mine, to put stuff into production, to move forward, to convince that team to do nothing is very difficult. And to convince them to be paid appropriately for doing nothing is even tougher.
And I guess that leads to my next question, is what can go wrong with a great optionality play? And is that one of the things where the management team decides to veer in strategy?
Absolutely. There's an incredible bias in the exploration development business. In fact, there's an incredible bias in commerce generally to do something. The right thing to do in optionality is to do nothing. Think about a company that has a very, very, very large deposit. I'm not going to name a name, but I'm thinking of one. A company 5 years ago that would have had a $2 billion market cap, that has one of the biggest copper gold porphyries in the world. This same company now, oh, and by the way, when it had a $2 billion market cap, it owned half the deposit. It has an $80 million market cap now, down from $2 billion, and it owns the whole deposit, so you get twice as much for about 4% of the price. The problem is that this company with an $80 million market cap is spending $2 million a month on general and administrative holding costs and trying to advance the property. So what basically happens to the shareholders is that the shareholders have this deposit with an $80 million market cap, but they're getting diluted by more than 25% a year, because the money that gets spent on G&A doesn't actually advance the property. Or if it advances the property, it doesn't advance the value of the property anywhere near as much as the equity issuances to sustain those costs dilute existing shareholders in the property. It's very, very important in an optionality play that the first thing that you do is nothing. Now, it is true, as many people who have successfully participated in optionality have discovered, that subsequent to this period, when demand begins to return for commodities and commodities begin to return to favor, and the share price goes up, hence the issuer's cost of capital goes down. When that happens, it may be appropriate to raise some money and do some exploration, because certainly the best place to look for gold or copper is around a gold mine or a copper mine. But during the point in time when the despair is pervasive, the share prices are low and the cost of capital is high, the right thing to do is nothing. Or if you do something, raise more money and buy another deeply out of the money deposit. One more thing, Tekoa, which I forgot to say. If you're going to play the optionality game, play it big. Don't buy little deposits. Buy great big deposits. Right now, gigantic copper gold porphyries, deposits that would have traded in the market for $1.5 billion or $2 billion or $3 billion are going to change hands in this market for $10 or $15 million. This is absolutely positively going to happen. It's going to happen because these deposits won't make any money till copper's at $3, and nobody knows when or if copper is going back to $3. It won't happen because people know that to put these properties in production would cost $2 or $3 billion. And the $2 or $3 billion necessary to put them into production won't happen in this market. But the truth is, every day we mine more copper, and the longer this copper price goes on, the more productive capacity we destroy in copper. We will destroy enough productive capacity in copper. Mark my words, supply destruction is occurring and will occurring, that we are in the future going to have copper shortages. And when that happens, the $3 billion deposit that somebody buys now for $15 million will command $3 billion again. This will happen.
Rick, I want to try to visualize this and also ask you a two-part question. How much of a time frame do we need to have in mind for a commodity price recovery to occur? to find success with an optionality investment? And does the general and administrative costs, the increase or decrease of those costs, does that resemble an option decay chart where we could think of it in our minds that the faster they spend, the quicker we descend down that pathway to zero, or the slower they spend, the longer the tail we get? Is that
answering your questions backwards? Absolutely. As opposed to a time decay, what you have is a spend decay, but your analogy is very useful. In theory, the decay in terms of the optionality here is very, very flat. It's really up to management and how much they spend. It isn't a time decay, it's a spend decay. Now, in terms of the time that people need to think about, when we were raising the money initially for the names I told you about earlier in the interview, the Silver Standards, the Pan American Silvers, the Lumina Coppers, all of these plays, we told investors to think in the context of 5 years. And I think 5 years is a realistic time frame. My own suspicion is that these stocks will begin to move in less time than that. But in order to really truly take advantage of the play, I think you need to think in 5 or 6 year terms. Certainly since I began thinking in 5 or 6 year terms, that occurred 20 or 25 years ago, my own results began to differentiate themselves, positively by the way, from my competitors who thought in much shorter time frames.
So Rick, why now? Why should a person consider doing this? Could there be 3 or 4 more years of downward trending commodity prices? What are your thoughts?
There absolutely could be 3 or 4 years. What I was trying to do, thinking about what to do in 2016, was really put myself through 2 exercises. What worked for me the best in the last cycle, and what is most hated now? At the top of the last cycle, optionality is what paid. At the bottom of the last cycle, optionality is what was hated. If you want to play the cycle, why wouldn't you think about the sector that worked the best, that was the most hated at the bottom, and is the most hated now? The other thing is that this addresses one of the critical concerns that those of us in this market have, which is actually 2 concerns. One is the explosion of general and administrative expense. The truth is that part and parcel of optionality is consolidation. The idea that one management team, rather than managing one project, could manage 5 projects. If what the investors ask the management team to do is nothing, why couldn't this management team manage 5 projects as easily as they could manage 1 project, when what you're asking them to do is nothing, or minimally maintain the projects? So getting larger amounts of assets under administration relative to general administrative expense is something that the industry needs, and it's key to optionality. Sprott will be looking for companies that are willing to amalgamate, for companies that understand that putting 5 assets together under one management team is the key to survival. Sprott will be writing checks sufficient to keep companies alive for 2 or 3 years, or 5 in the right set of circumstances. And we aren't the only institutional investors who are committed to doing this.
Rick, for the person watching, what do you feel is the most intelligent way that they can go about learning and participating in this process?
Well, I'm prejudiced with regards to this, but I suspect that the only institutional investor in the world right now trying to cause this to occur is Sprott. But if you want to look backwards and see how this mechanism plays out, go on the web and look up the share price history and read the press releases on a historical basis of companies like International Uranium, Paladin Resources, Pan American Resources, Silver Standard Resources, Vista Gold, Lumina Copper. Look at the strategies that worked in the last market and look at how well they worked. If you follow the lessons that we've talked about before in this video series on securities analysis, and you apply these lessons retroactively to the names that I just named, you will understand extremely well the thesis with regards to optionality.
Well, Rick, in winding down, do you think there's anything we may have missed?
I don't think so. I think that most people invest in commodity-based stocks because they think that the commodity price is going to rise. If you believe that the commodity price is going to rise, rather than looking for a commodity, why wouldn't you buy a commodity? Further, if you believe that the commodity price is going to rise, why on earth would you produce the commodity when the price is low, so that when the price rises, you don't have any more of the commodity left? And one more thing, Tekoa, that I did forget to say. One of the things that happens consistently during periods of low metals prices, low commodities prices, is that the industry high grades. That means that they produce the best part of their deposit to lower their current cash cost to survive. What that means, however, is that when the commodity price begins to go up, the best part of the deposit has already been mined. So they have to mine the lower grade parts of their deposit, so their costs rise. Think about this, Tekoa. In 2000, when the gold price was $260 an ounce, by 2011, the gold price had run to $1,900 an ounce, and per share cash flows in the industry had declined. The gold price went up sixfold, and per share cash flows had declined. What happens is, in any market, when the price goes up, there will be a need for new deposits. And probably the best way for an investor to address this is not high grade, not mine when the prices are low, but rather hoard when the prices are low and sell the deposit intact when the prices are high and the industry is screaming for it. Remember, maybe the first interview we did, buy low, sell high, rinse, repeat. That's what hoarding is all about. That's what optionality is all about.
Rick Rule, Chairman of Sprott U.S. Holdings, thanks for sharing your comments with us.
Thanks for the opportunity, Tekoa.